question: how do we decide which loan is best suited for your situation? So primarily this comes from understanding your situation. So my background is financial planning, and so I see understanding where you're at the moment, plans for the future, and exactly what it is that you're doing now is very, very important. So I generally gather quite a bit of information around your requirements, and generally we'll set up, I guess, a type of matrix or Excel document, if you like, with a list of different requirements, which ones are more important. And so this is just in terms of my kind of working documents, so that you can get in my head a little bit of what's more important. Interest rates more important? Is branch access more important? Is the assessment time frame an important consideration? How liberal the assessment team is at the lender? Ease of escalation? General likability of the bank itself or the lender? Online functionality. How good is it? Does it have an app? Do you need an app? Are you using an app right now for your general day-to-day banking? And does that need to link up with your loan? The purpose for the loan itself, is it for constructions? Is it for structural renovations? Is it for non-structural renovations? Is there an aspect of cash out? So cash that you're actually taking out from the loan in equity to use for a specific purpose. How much cash out are we taking out? Are we taking out 50,000, 100,000, 200,000? The general serviceability. So how much can we actually borrow with that lender when taking into account different income factors? Is there an offset facility? Do you need an offset facility? Is there a redraw facility? Are there general banking facilities? What are the sorts of bells and whistles that we can actually get on the loan that we might or might not need? Is the loan portable? So if you're buying now but you know that you're going to be moving in 3 or 4 years, perhaps it's good to have portability so that you'll be able to stay with the same loan and exchange one property for the next, potentially. What about down to the specific policies themselves? So things like maternity leave policies, someone on maternity leave. Can we actually use that return to work income? Can we use partial income? How does the bank actually see that? What about application fees and size and history of the lender that also come into play? What about the deposit requirements? Can we go to 90% interest only with an investment? A lot of lenders have dropped off that recently. What about their income policies when it comes to non-base income or self-employed income or bonuses or salary paid as a self-employed as opposed to director's fees? Are they different? Are they seen differently? What about genuine savings? Can you borrow up to 90%, 95% without the need for genuine savings potentially? How much of a gift can you actually be given from someone and still meet the requirements of the loan? What about living rent-free? Can you actually say to the bank, I'm not paying any rent, I'm living at home, and the bank accept that? Or will they have some sort of minimal requirement to still put against you? What about the type of property? Strata property versus community title versus fully detached Torrens title property? What about leasehold? What about a second mortgage? Does your lender allow another lender to sit on top as a second mortgage? Is that something that you might potentially need in the future? What about bridging loans? Does the lender do a bridging loan? How do they actually do it? How does the bridging service? What actually happens in the calculator? Now, they are very specific and very different across different lenders. And what about construction generally? Or things like split contracts. If you're buying land and building, do you have to go with a specific builder, but you're actually going to start paying for it partway through the build? So that and other, I guess, specific kind of type policies all come into play when we're looking at exactly why one loan might suit someone where another loan might not actually suit them that well. And it doesn't all come down to the next 1 month, the settlement date, the next 2 months. There might be things further down the track that someone may not think of if they're not asked the right questions or if they don't ask the right questions. And so their loan actually isn't that great 3 years down the track. Or you might take out a 5-year fixed loan, but be planning on selling the property in a year's time just because you have to. I mean, buying and selling in a year is probably not a great option, but it's a good example of something happening in the future. You probably don't want to be in a fixed loan if you're going to have to sell in the very near future. Hope that has clarified that question.